The markets are officially closed today, Thursday, November 27th, 2025, in observance of Thanksgiving, which means the figures we are looking at are finalized from yesterday's closing bell. And what a close it was! Beyond Meat Inc., trading under the ticker symbol BYND, ended the last trading session at exactly $1.01, registering a staggering intraday surge of 18.42%. That is a 19% move in a single session for a company that many critics had left for dead. If you are looking at your screen wondering how a stock trading near penny territory suddenly wakes up with this kind of violence, you are not alone. The expectation here was clear. A company facing a massive $38.9 million legal verdict for trademark infringement should have been crushed. The expectation was for a sell-off, a panic, a retreat to new lows. But the reality? The reality was a vicious, counterintuitive short squeeze that defied every fundamental logic in the book. This is the tension between what the headline says and what the market actually does, and that is exactly where we need to focus today. The narrative surrounding Beyond Meat has shifted from a story of growth to a story of survival, and yesterday's price action perfectly encapsulates that struggle. When news broke that a jury in Massachusetts found Beyond Meat liable for infringing on a competitor's trademark, specifically owing nearly $39 million to a company called Vegadelphia, the immediate assumption was that this would be the final nail in the coffin. For a company already burning cash, facing declining revenues, and managing a heavy debt load, a $40 million penalty is catastrophic. It represents more than half of their reported revenue for the third quarter alone. You would expect the algorithms to read liable, damages, and infringement, and then immediately dump the stock. That is the rational expectation. But the market, especially when it involves highly shorted stocks like BYND, is rarely rational in the short term. The reality is that this stock is so heavily bet against, with short interest hovering between 20 and 50% depending on the data source, that even bad news can trigger a rally if it is not quite as bad as the absolute worst-case scenario, or if liquidity dynamics force short sellers to cover their positions to avoid unlimited risk. This is a classic sell the rumor, buy the news event flipped-flopped on its head. Bad news hit, but the stock was already so beaten down that traders used the liquidity event to squeeze shorts out of their positions, driving that 19% rally we just witnessed. Now, before we get too deep into the mechanics of this squeeze, I want you to take a second and comment below. Do you think the plant-based meat trend is just a fad that is past its expiration date, or is this a sector that will eventually replace traditional agriculture? I'm genuinely curious because the sentiment on this is more polarized than Tesla stock or Apple stock ever was in their early days. Drop your thoughts in the comments. Let's step back and look at the broader picture, because this 19% jump didn't happen in a vacuum. It is crucial to understand the meme stock revival context here. Just a few weeks ago, we saw Beyond Meat surge nearly 600% in a matter of days, driven by retail frenzy and social media hype on platforms like Reddit and StockTwits. This recent move to $1.01 is a localized echo of that volatility. The psychology here is fascinating. When you trade on platforms like Robinhood or use apps like the Fidelity mobile app for your individual brokerage needs, you are seeing a democratization of flow that allows retail traders to spot these heavy short interests and target them. It's similar to what we see with SoFi stocks, or even when people use Schwab Intelligent Portfolios to gain exposure to different sectors. The accessibility of data means everyone knows Beyond Meat is in trouble, and everyone knows the shorts are crowded. When a stock is trading at $1, it acts like an option. The downside is capped at 0, but the upside, if a squeeze triggers, can be exponential. That asymmetry attracts the same kind of speculative capital that chases crypto on Robinhood Crypto or penny stocks on Interactive Brokers. However, we cannot ignore the fundamental gravity weighing on this company. The legal defeat against Vegadelphia is serious. The jury decided that Beyond Meat's use of the slogan, "Great Taste, Plant-Based," infringed on Vegadelphia's "Where Great Taste is Plant-Based." This isn't just a slap on the wrist, it is a direct hit to their cash pile. Beyond Meat has stated they will appeal, which kicks the can down the road, but the uncertainty hangs over the stock like a dark cloud. This legal battle adds another layer of complexity to a company already undergoing a massive debt restructuring. If you recall, back in October, Beyond Meat engaged in a debt for equity swap that was essentially a lifeline to avoid bankruptcy. They exchanged heavily distressed convertible notes for new notes and, crucially, a massive amount of new equity. We're talking about hundreds of millions of new shares hitting the market. This dilution is why the stock is trading at $1 and not 10. Existing shareholders were diluted significantly, their slice of the pie shrinking dramatically to keep the lights on. It's a harsh reality of corporate finance that you might not see discussed often if you are just casual with your online investing or using simple investment help tools. This brings us to the operational reality of Beyond Meat. The company was the darling of Wall Street just a few years ago, promising to revolutionize the way we eat. They had partnerships with McDonald's, KFC, and PepsiCo. The expectation was that by 2025, we would all be eating plant-based burgers. The reality has been a stark contraction in demand. Inflation has hit the grocery aisle hard, and when consumers are choosing between expensive plant-based alternatives and cheaper traditional meat, they are increasingly choosing the latter. The health halo of plant-based meat has also slipped, with more consumers questioning the processing and ingredient lists of these products. This macroeconomic pressure is the backdrop against which this stock is trading. When you look at their Q3 earnings, revenue was down, margins are still under pressure despite cost cutting, and cash burn remains a primary concern. They are in a race against time to right the ship before the liquidity runway ends. It's interesting to compare this to how one might manage a personal portfolio. If you were using Fidelity Wealth Management or looking at Fidelity ETFs, you would be advised to diversify away from such concentrated risk. But for the traders driving this volume, over 60 million shares traded recently, risk is the point. They are playing the volatility. It's the same adrenaline that drives activity on the Interactive Brokers trading platform or keeps people glued to the Robinhood app. The volume we saw yesterday indicates that this isn't just a few retail traders. There is significant institutional shuffling going on as well. Some funds might be closing out short positions to book profits before the year end, realizing that the stock at $1 doesn't offer much more downside to squeeze out compared to the risk of a random rally. Others might be buying in, betting that the brand value of Beyond Meat is worth more than the current market cap suggests, creating a potential acquisition target for a major food conglomerate. Let's talk about that acquisition possibility because it's a scenario that keeps coming up in the expectation part of the narrative. The common belief is that a giant like Nestle or Tyson might swoop in and buy Beyond Meat for its brand and IP. The reality, however, is that an acquirer would also be buying the debt and the legal liabilities, like this new $39 million verdict. That makes the deal much less sweet. It's not as simple as buying Nvidia stock and riding the AI wave. This is a distressed asset play. It requires a different kind of investment help or analysis than simply picking a growth winner. If you are self-investing here, you have to be incredibly careful. The difference between a $1 stock and a $0 stock is 100% loss, and bankruptcy is still a word that analysts are whispering, even if the recent restructuring bought them some time until 2030 for the bulk of their debt. The technicals on the chart are also painting a chaotic picture. The stock has support around the 85-cent level, which it bounced off recently, but resistance is heavy at the $1.20 mark. Breaking above $1 and holding it, as it did at the close yesterday, is psychologically significant. It keeps the stock compliant with exchange listing rules for now, avoiding the dreaded reverse stock split conversation that often signals the end for struggling companies. If you are using technical analysis tools on SoFi Invest or the Fidelity trading platform, you will see that the moving averages are all pointing down in the long term, but the short-term momentum indicators like RSI are flashing oversold then bought, creating these whiplash moves. I want to pivot back to the expectation versus reality framework regarding the product itself. The expectation was that the price of plant-based meat would come down to match beef as production scaled. The reality is that achieving price parity has been incredibly difficult due to supply chain complexities and the high cost of pea protein and other inputs. This failure to reach price parity is arguably the biggest fundamental headwind they face. Without being cheaper or at least the same price as beef, it remains a premium product in a non-premium economy. This is why you see them pivoting to strategies like the BYND IV platform, trying to improve taste and health credentials to justify the price. But is it too little too late? That